You know, in the world of finance, we're swimming in charts and indicators. But there's one that economists and investors watch with this almost superstitious reverence. It's just a simple line on a graph, but its predictive power, that's the stuff of legend.
Seriously, what if I told you that a single, simple line could tell us with almost scary accuracy when an economic storm is brewing just over the horizon? Sounds kind of like financial voodoo, right? But the data? Well, the data tells a very different story.
And that's what we're digging into today. We're talking about maybe the single most powerful predictive tool in all of economics, the yield curve.
So what's the big deal? Why all the hype? Why does this one graph get so much attention from the Federal Reserve all the way down to Wall Street and even Main Street?
Well, it's because the yield curve isn't really just about numbers. It's about people. It's a snapshot of what millions of investors all at once believe about where the economy is headed. Think of it like a measure of collective confidence or collective fear.
Okay, so to really get this, we've got to break it down to its two basic building blocks. We're talking about bonds and their yields.
First up, yield. Let's make this super simple. Yield is basically your return on investment. If you buy a government bond, the yield is the total profit you're going to make from all the interest payments if you hold onto it until it expires. It's what the government pays you for the privilege of borrowing your money.
So the yield curve itself is just a graph that plots all these yields. We take a whole bunch of U.S. government bonds. Some are short-term, just a few months. Others are long-term, like 30 years. And we just line up their yields on a chart. What we get is a curve, a picture that shows us the relationship between time and money.
And here's where it gets really interesting. The shape of that line, that's everything. It's like a visual language that tells a story about the economy.
Okay, so you've basically got three main shapes to look for. A normal curve slopes up. That means investors are feeling good, they expect a healthy economy, and they want higher returns for locking up their money for a long time. Makes sense. A flat curve, that signals uncertainty. People are a bit nervous. But the one that gets everyone talking is the inverted curve. It actually slopes downward. That means short-term bonds are paying more than long-term bonds. And that is a massive signal of pessimism.
And that feeling of pessimism, it's not just a hunch. Historically, it's been an almost perfect warning shot for what's to come.
And here is the kicker, the stat that just blows you away. An inverted yield curve has shown up right before every single U.S. recession for over 60 years. I mean, just let that sink in. Every single one. We're talking about an indicator with an almost flawless track record.
And this just lays it all out so clearly. Look at this pattern. The curve inverted in 1989 and boom, about a year later a recession hit. It inverted in 2000, right before the dot-com bust. It inverted again in 2006, well before the huge financial crisis in 2008. The warning consistently shows up about 12 to 24 months in advance. It's like clockwork.
So you're probably wondering, how many times has this thing been wrong? Since 1960, there has been exactly one false positive, just one. And even that one time was followed by a pretty sharp economic slowdown. It's just an astonishingly reliable signal.
Okay, but this isn't just some abstract thing for economists to argue about. An inverted curve has real-world effects that can hit you right in the wallet.
So here's how it really impacts the economy through the banks. See, banks make money in a really simple way. They borrow short-term, think of your savings account, and they lend long-term, like for a 30-year mortgage. When the curve inverts, their borrowing costs go way up, but what they earn from lending goes down. Their profits get squeezed. And when that happens, they have way less incentive to lend money, which puts the brakes on the entire economy.
This brings up a super common question, and a really good one. If an inversion means long-term yields are falling, why don't our mortgage rates fall with them? Why do they seem to stay so stubbornly high?
It all comes down to what everyone thinks is going to happen next. When the curve inverts, everybody, you, me, the banks, expects interest rates to be lower in the near future. So homeowners start planning to refinance as soon as those better rates pop up. For a bank, this means that 30-year mortgage they just gave you might only actually last a couple of years. So they price it based on the higher short-term rates, and that keeps your mortgage payment up.
Which brings us to right now, to the really strange case of what's been happening lately. The yield curve inverted way back in October 2022, and it stayed inverted for the longest stretch in modern history. But the recession that everyone predicted never actually showed up. So what happened?
It looks like a few really unique things were going on this time around. For one, households and banks were sitting on a huge pile of cash from all the pandemic stimulus, and that acted like a buffer. The job market also stayed incredibly strong, so people just kept spending. And here's a crucial one.
Banks didn't feel that profit squeeze as much because even as their borrowing costs went up, they kept the interest rates on our savings accounts near zero. All of these things kind of work together to cloud the signal.
And this leaves us with this huge question. Was the 2022 inversion a sign that this legendary indicator has finally lost its magic in this new economy? Or was it simply a very rare exception to a rule that has held true for over half a century? Honestly, only time is going to tell.